In today's video, we'll be examining whether $950,000 is actually enough to retire comfortably without ever having to work again. Through analyzing thousands of retirement scenarios and running detailed financial projections, I've discovered that $950,000 is actually more powerful than most people realize when structured correctly. That's exactly why I'm making this video today, to show you how 950,000 nest egg can provide lasting retirement security, what specific strategies make this possible, and how to determine if you're ready to leave the workforce for good with this amount. Let's get right into it. Let's start with the question on many people's minds. Is $950,000 enough to retire on? A $950,000 portfolio using a conservative withdrawal rate of 3.25 could generate roughly $31,000 annually. That's based on a recent academic and financial industry guidance on sustainable withdrawals in today's lower return environment. So why does this number matter? Well, according to the Bureau of Labor Statistics, the average annual expenditure for households headed by someone age 65 or older is roughly $52,000 per year. That means the $950,000 portfolio alone won't cover all expenses for the average retiree. But this isn't the whole picture. Let's add in Social Security, which for the average retired worker provides about $1,900 per month or $23,000 per year. Combined, a $950,000 nest egg and average Social Security benefits could give you a total annual income of just over $53,000, which meets or even slightly exceeds the average retirement spending benchmark. So yes, $950,000 is realistic if you plan and withdraw wisely. But if you're hearing advice that you need $2 million to retire, you're not alone. Many online calculators and financial headlines promote inflated figures, often using blanket assumptions that ignore your actual expenses or your unique situation. They also really factor in reduced expenses in retirement. No mortgage, less commuting, no work attire, lifestyle changes, downsizing, fewer dependents, and even geographic flexibility, lower cost of living areas. All of these can reshape what 950,000 can really do for you. Now that you understand the true potential of a 950,000 retirement portfolio, let's examine the specific strategies that make this amount sufficient for a permanent exit from the workforce. Let's talk longevity. How do you make 950,000 stretch across a 25 to 35-year retirement? What investment strategies maximize the longevity of 950,000 retirement portfolio? Here's where it gets personal. You really need to understand two things: your risk tolerance and your risk capacity. Risk tolerance is emotional. How much volatility can you stomach without panicking? Risk capacity is mathematical. How much risk can your plan handle without jeopardizing your ability to cover expenses? Just because you can tolerate big swings doesn't mean your portfolio should be exposed to them, especially when you're relying on those funds for income. The opposite is true too. Being too conservative might mean your money doesn't grow enough to keep pace with inflation. That's why a portfolio designed to last needs a mix of growth assets like equities and stabilizers like bonds and cash. If you're 60 and healthy, you might have 30 years ahead of you. So you need growth. But you also need to avoid having to sell stocks in a downturn to cover your monthly bills. That's why building a personalized mix around your specific risk capacity. How much downside your plan can withstand is the foundation for a sustainable retirement portfolio. How does proper diversification extend the life of retirement savings? Think of it like not putting all your eggs in one basket. By spreading your money across US stocks, international equities, bonds, and maybe even some real estate, You're protecting yourself from any one market crashing your whole plan. Now, why does a balanced approach between growth and income prove most effective? Because you need income to live on, but you also need growth so your money doesn't run out. Inflation doesn't stop just because you're retired. Keeping some assets growing helps keep up with that. Instead of taking out the same amount every year, dynamic strategies adjust based on the market. So if markets are down, maybe you cut back temporarily. If they're up, you enjoy a little more. It keeps your portfolio healthier. Now, all of this runs counteractive to generic retirement advice, like the 4% rule. So why does the traditional 4% rule need adjustment for today's market realities? Low bond yields and market uncertainty have led many experts to suggest 3 to 3.5 might be more realistic today. Morningstar recommends starting closer to 3.3. But why do financial advisors often overstate how much you need for retirement? Most of the time is to be safe. They want to protect you against longevity and health surprises. There are hidden assumptions in standard retirement calculations that can lead to excessive saving targets. Things like assuming your expenses won't change, or that inflation will always be high, or that you won't downsize. Those assumptions skew your target number upwards. Most retirees spend less as they age. Commuting stops, houses get paid off, kids are hopefully independent. But a lot of planning tools just assume your spending stays flat or even grows. That's not the case for many people until the much later years of retirement, and that's usually for health-related expenses. Now, how does Social Security dramatically change the 950,000 retirement equation? Social Security is the great equalizer here. The average benefit is around $1,900 a month, or roughly $23,000 a year. If you're married and both spouses qualify, that could be $40,000 annually. How can adjusting withdrawals based on market performance add years to your retirement savings? Simple idea, don't sell low. If markets drop, withdraw less. Also, consider creating a pension-like income floor with annuities. For instance, a single premium immediate annuity could generate guaranteed lifetime income, reducing pressure on your investment portfolio. This approach blends stability with flexibility. Secure your needs and invest the rest for potential growth. What kind of lifestyle can this support? Let's break it down. Average retirement spending, $52,000 a year. Portfolio withdrawals, 3.25 of 950,000 is 31,000 a year. Social Security average, 23,000 a year. Together, that's 53,000 per year. A solid middle-class retirement. Now, quickly, if you feel you are in this situation and have no idea what the next step is for your specific situation, we've put together a complimentary retirement review for your specific situation where we walk through exactly how to build out your retirement plan. And look, the worst thing you can do is delay your retirement out of fear. So to learn more, click the link below in the description after this video. But hurry, we're only doing this for the first 30 people that register. But the biggest variable in making $950,000 last. For example, in Tampa, Florida, or Phoenix, Arizona, 950 can go a lot further than in Boston or San Fran. In states with no income tax, like Florida, Texas, or Nevada, you retain more of your income. Next, we have housing costs. Downsizing, relocating, or even renting in a retirement-friendly community can significantly reduce expenses. And don't overlook healthcare. The average couple retiring today at 65 will need between $184,000 and $380,000 to cover out-of-pocket medical costs in retirement. Supplemental insurance, HSAs, Medicare optimization are essential strategies to protect your savings. Understanding how to adapt to economic changes is crucial for making your $950,000 last throughout retirement. Let's examine how to protect your retirement from inflation and market volatility. Let's talk about something that doesn't always get enough attention: how your retirement savings stand up to economic changes like inflation and market up and downs. It's a big deal, especially when you're no longer working. How does inflation impact 950,000 retirement over time? Inflation slowly eats away at your purchasing power. Even just 3% inflation can cut your buying power in half over 24 years. And in 2022 and 2023, we saw inflation spike. It hit 6.4 in 2023. It's a huge wake-up call for retirees. Why does failing to account for inflation lead to retirement shortfalls? If your income doesn't grow while your expenses do, you're going to fall behind. It's like trying to run up a down escalator. What seemed like a safe plan at age 65 may not look so great at 75. So, what strategies help protect your income from inflation? One potential move is delaying Social Security. Every year you wait past full retirement age, your benefit grows by 8%. And that benefit is adjusted for inflation each year. This gives you a bigger inflation-protected income source. What investments provide better inflation protection? Things like Treasury inflation-protected securities, dividend-paying stocks, real estate investment trusts can help. They either adjust with inflation or generate income that tends to keep pace with rising prices. How do you adjust withdrawals to keep up with inflation without draining your savings? Some retirees use a dynamic withdrawal strategy, meaning you pull a little more when markets are good and you tighten the belt when things are down. This helps your money last longer. What about those early years of retirement? Are they really that risky? Yes, big time. It's called sequence of returns risk. If the market drops early in your retirement and you're withdrawing at the same time, it can devastate your portfolio. You're selling low and you have less capital left to rebound when things improve. So how do you protect against that? Use buffer assets like cash reserves, short-term bonds to cover your spending during downturns so you don't have to sell stocks at a loss. Another smart approach is the bucketing strategy. Keep 1 to 3 years of cash in one bucket, intermediate term income in another, and long-term growth investments in a third. The key here is to build a retirement plan that can bend but not break, one that adapts as the economy changes. That's what keeps you sleeping well at night. Now that you've seen how these strategies can help make $950,000 last throughout your retirement, let's look at how you can use this information to optimize your retirement plan. So, how do you know if $950,000 is enough for you? Calculate your retirement income needs using your current expenses as a baseline. Estimate Social Security benefits accurately using the Social Security Administration's retirement estimator tool. Determine your safe withdrawal rate. Factor in inflation and healthcare costs. Adjust for flexibility. If you're willing to move or change spending habits, your portfolio goes further. Your action steps. Use dynamic withdrawal models. Explore guaranteed income tools like annuities. Diversify across classes. Consider tax-efficient withdrawal strategies. Plan for Medicare and gap years. And finally, remember, retirement success isn't just about money, it's about confidence. Life satisfaction research shows that fulfillment in retirement is more tied to relationships, health, and purpose than spending levels. Now that you understand the true potential of 950,000 retirement portfolio, you can make an informed decision about whether this amount is sufficient for you to never work again. If you're looking for more help planning your dream retirement, we are offering to review your finances and retirement situation to see if you are on track. To discover exactly how to implement these strategies and create the retirement confidence, click the link below, and we'll see you in the next video.